Harsha Upadhyaya, CIO for Equities at Kotak Mutual Fund. He's joining us on the show right now. Harsha, good morning to you. Obviously, this week in particular started off on a big bang note. We've carried forward now once again rescaling those levels of 10,800 odd, primarily driven by some cheer within the global markets and commentary coming in from the Fed chairman about interest rates and the pace of that. But what's your sense in the overall setup right now? Where are we expected to head?
As far as Indian markets were concerned, there were a couple of concerns to begin with in the last couple of months. Our own local NBFC funding issues and the liquidity squeeze therein. The adverse impact of crude and currency moves, and also some bit of concerns about the interest rate trajectory going forward. Out of these concerns, I think most of them seem to have resolved themselves or in the process of slowly moderating. So to that extent, there has been a positive undertone to the market. But at the same time, we have to remember that there are a couple of big events in front of us as far as Indian equities are concerned. One is obviously the state election results, which will come in the mid of December. And thereafter, I think, depending on the state election results, there will be a lot of developments that will happen on the political side, which will also drive sentiments until the final election results are out. So to that extent, we tend to believe that the next 6 months could be a phase for consolidation in Indian equities.
Obviously the volatility right now is still expected to remain considering elections that are around the corner. But for an investor who's probably looking at value picking right now from a 5-year standpoint, churning his portfolio a bit, making sure that there is a right balance of defensives, come high beta, where would those changes likely occur according to you?
Clearly, large cap segment has been more stable compared to mid and small cap segments over the last 12-18 months. So to that extent, any portfolio that has withstood the recent volatility should start making some investment picks in the mid and small cap basket, in our opinion. And that is where the valuations have corrected significantly from the peak. In many cases, the valuations have corrected by 30 to 40%. And those are the names, if you believe that in terms of earnings growth rates, they will still sustain the earnings growth rates that we were predicting earlier. At 30-40% lower valuations, definitely they become reasonably good buys. At the same time, I don't think it is still time to go very aggressive on mid and small caps. There are pockets of overvaluation even there. So it has to be more of a stock specific picking within mid and small cap segment, with a view that over the next 6 months you would build a portfolio which will have a larger component of mid and small caps. And post elections, if you find a stable government, that should give you reasonably strong returns over the next 3-5 years.
Harsha, good morning. Neeraj here. When we're talking about this phase of consolidation, would you expect that to happen even if the Fed would go slightly slower on the rate hike trajectory and global flows might come into India? I mean, how have we viewed such cycles in the past? Because I don't think this has happened too many times wherein FIs would get a left out feeling because they have sold out at a time when the Indian markets have consolidated and actually come back to those 17-18 P multiples.
Neeraj, our view is big chunks of money may not come in before elections until and unless the valuations become even cheaper and a compelling one. So if markets remain at these kind of valuations, yes, there could be a little bit of positive bias that will come because of the likely delay in the interest rate hike cycle in US and other markets around the world. But I don't think large chunks of money would come in before elections if current valuations hold. So either we need a time correction or we need a value correction. So then only I think we will see big amounts of money from foreign investors. As far as the domestic liquidity is concerned, I think the retail investors have been working very smart and they have been putting money through SIP. And we haven't seen any change in that momentum, despite some of the local issues and despite volatility that we have seen in the market. So to that extent, that flow should remain quite strong even going forward.
Okay. So what could bring about that valuation correction, if I can kind of dwell upon it a bit, Harsha? The Fed fears seem to be receding for now. I wouldn't call it out of the window because we don't know what the Fed will do. But let's assume that it's parked on the side for the time being. If indeed the G20 proves out to be a non-event of sorts, and even out there people have said if the trade war comes in, India is actually in a sweet spot. Having said that, let's assume that the G20 pass off uneventful and the election results don't throw up any negative surprises from a market perspective. What can bring about a valuation correction?
I think apart from the issues that you mentioned, assuming that they don't really spook the markets, the other issue that we will have to look at would be the earnings growth trajectory. We have already seen downgrades for FY19 numbers after the second quarter results, and third quarter will also have some impact of higher crude prices and hence higher raw material and fuel costs for Indian manufacturing. We have seen the liquidity tightness that has come into NBFC market, which means the lending that would happen from an NBFC segment would also take a hit during this quarter and maybe for the next few months. Given all this, we could see some bit of slowdown in discretionary consumption, along with some elevated raw material or fuel costs, which eventually would become a tailwind, but at least for this quarter there could be some impact in terms of lower margins on the profitability side. So given all this, the current valuations are not so compelling. I'm not saying that one should be looking at exiting equities or reducing equities at this point of time, but to make a clear case for increasing investments, there needs to be a lower valuation, and that could come by because of the earnings risk that the market is carrying.
You believe that there is a higher probability, Harsha, at the end of quarter two? I mean, what H1 has done for us. And just a word on where do you think, or which sector or which space do you think is the most vulnerable for a market disappointment on the earnings front? Or where is it that you believe the earnings uptick will not be as much as the market seems to be believing?
I think clearly consumption-oriented sectors are running that risk. We have seen volumes slow down in case of automobiles and other discretionary consumption items. While on the consumer staple side, the volume growth and the margin performance has been very, very strong. What we need to see is where the valuations are. I mean, most of the consumer staple names are at historically high valuations. So to that extent, even a small miss there could also lead to corrections in those set of stocks. So overall, we believe consumption is one area which has done very, very well for last 4-5 years. And we have seen volume growth which has been very steady and strong. We have seen margin expanding. We have seen market share gains for at least the listed space. I think that issue could come under some bit of strain if we see this NBFC funding issue and related liquidity issues get extended over the next few months.
Right. Just coming on, the commodity-related plays right now, Harsha, be it on the back of crude, be it on the back of what's been happening in China with regards to steel prices coming off, and the implications thereof within the equity markets here, and whether or not the inter-commodity plays are something that you would look at favorably.
We continue to remain underweight on the global commodities because we really do not see the entire risk of tariff war evaporating at this point of time. There is some more clarity that we require until we take a view on the tariff war, how it's going to pan out. And secondly, given the fact that global growth is tapering, the demand side is also looking relatively weak compared to where we were maybe 12 or 18 months back. Both these issues put together, I think while we have seen correction in some of the global commodities, that could continue for some time, or we may not see real bounce back in some of the business fundamentals therein. Instead, we are playing a local commodity which has very, very strong growth trajectory as of now, and we have also seen some of the raw material and the fuel costs coming off, which is in the cement sector, and the strength in the volume growth gives us confidence that over the next 2-3 years, this should be a sector which will deliver much higher returns than the market. One, it is not leveraged in terms of financial leverage, and there is a lot of unused capacity on the production side. And in a sector where the demand is growing at mid-teen level, slowly and surely you will see capacity utilization rates inching up, and we have also seen some of the cost pressures easing in the recent times, both of which put together we should see a reasonably strong outperformance from this sector.
Okay, that's for the cement space. Harsha, the other pocket is obviously going to be IT. Mid-cap IT in particular, we've seen the rise and fall of it. You've seen specific stocks just zoom ahead and valuations looking a little bit more stretched. They had their recent downfall as well. But do you see a case for, any of these companies probably taking it to the next big league? Maybe in the form of innovation, not just pure play IT, but just focusing on specific segments and creating a niche for themselves to take that big leap of growth?
While I do not want to comment on stock-specific opportunities, the valuations that were there in the mid-cap IT segment were not comfortable, at least for us. In fact, if you remember, our earlier interactions were always concerned about the mid-cap IT valuations, because the growth rates were more or less similar to large-cap, or in some cases even lower than large-cap IT stocks, but the valuations were at a premium to large-cap IT stocks. And that has corrected quite nicely in the recent pullback. Now the valuations are no more a risk for mid-cap IT companies. But then again, I think you will have to be focusing on the kind of areas in which they are operating, and what kind of capabilities they have to move to the big league. And if you believe that any company has those kind of strengths, then at these valuations, they are reasonably good investment ideas.
Okay. Harsha, just the new norm, and even that's under threat, by the way, today, with the currency almost ready to shoot on the upside and northwards of 70 yet again. But if you will, the new normal seems to be that while crude has recovered and everything else has been volatile, the rupee is sub 70. Now, my question to you is there a case for either import substituting spaces to do really well? You spoke about one export-oriented pocket. The others would be subject to business feasibility. But would you believe import substitution could be a big theme over the course of the next 12 to 18 months as the currency kind of plays favor to that swing too?
It could happen, but we'll have to wait and see which of those industries would really be able to compete with the quality, or whether those industries have excess manufacturing capacity at this point of time. So still it is not a very clear trade to us, but yes, there will be some benefit that will happen to at least some of the industry segments which are closely linked to rupee dollar equation, and at lower rupee levels, obviously that competitive advantage for Indian manufacturing will go up.
Harsha, I know you don't, I don't want to get into a stock specific discussion, but what would happen in a case of a large bank which is going through multiple pressure points and not just one? Even if valuations were to be favorable, and I'm just talking about what's happened to certain other pieces in the past as well. This is not a yes bank specific question or discussion, but what would happen to such instances? Would the market not feel tempted to buy into a really into the valuations because the certainty around the operations and the quality of management and the board, etc., is in question? Do you think the market will continue to shun such cases? It's happened with a couple of other private banks in the past as well.
Usually, if you look at any stock which comes under the corporate governance controversy or some of the issues which could completely change the business scenario, then ideally most investors would wait for some kind of a clarity or a roadmap in terms of where the our future is headed. Once that is clear, slowly people will start looking at some of those businesses once again. But as long as the controversy remains or where clarity is still not coming by, then I would say that there is always a question in terms of valuations as well, because while some people may believe that the valuations have corrected quite a bit, there could be other section of market participants who would feel that even with the lower valuations there is still no clarity, and those valuations could be just optical. So there will always be two views in case of uncertainty, and markets really don't like uncertainty, and that's what happens in some of those cases.
Okay, interesting. The other pocket, Harsha, which, and I heard you mention at the start of the conversation that you believe consumption-oriented names could have a case of earnings disappointment. Now, let's break it up. And I don't want to talk about staples, but more the discretionary side. They've already shown chinks in the armor, and the market has already discounted some bit of it. Auto names have come off and come off quite rapidly. Large auto ANGs have also come off quite rapidly from the highs that they were trading at. So valuation may not strictly be the concern out here. What would happen here? Autos in particular, would it be a concern on growth and therefore they stay sideways? Or would you presume that there will be a bounce at some point of time in the auto space?
Our view is if margins are going to be under pressure and the volumes are unlikely to show similar strength as what we have seen in the past, there could be case for earnings revision, downward revisions in case of at least some of the auto companies. If that were to happen, even after witnessing some amount of correction from the peak valuations, the valuation may still look on the higher side, because remember, these are the set of stocks which have done really well over the last 5-6 years, and there was a case for them to really do well as well. I mean, the volume growth generally was very, very strong. They had no pressure on the margins, there were no discounts in the market, and it was very smooth for the entire basket. And now, on the back of that, we have seen the valuations going up, and much more than where they were historically trading or where the market was trading, in at least in some cases. And if in those names the growth becomes an issue, then I think there is a case for valuation correction as well. But other than that, if volume growth doesn't come through, broadly most of these stocks would at best move sideways.
Harsha, one sector obviously that's in focus of late has been the real estate space now, and the NBFC exposure that they have to some of these bigger real estate players, and what's been happening thereof. Most of the real estate players though feel that they're in a comfortable position to service all of those borrowings via the lease rental model. But what's your take on the space as a whole, and whether or not we'll see a turnaround anytime soon?
We believe that the current issue is still not fully resolved. There is some bit of pressure on the real estate developers and the companies in terms of availability of money. Most of these names, especially the suspect ones, were getting money from NBFC segment rather than banks. And also, mind you, the banks cannot lend as per the regulations for land purchases. And most of the land purchases where the cash flow would come in over a period of time, not immediately, were financed by NBFC segment. So that is something that one needs to watch out for, and that is where the pressure would start coming in. If you believe that the NBFCs will be unable to roll over some of those loans lent to developers in the next few months or next few quarters, who is going to fund those land banks? Because banks are unlikely to, and they're not allowed to fund those land banks. So we'll have to wait and see how this pans out. At the same time, we all know that the purchases on the real estate side have not been very encouraging for quite some time now. So given slow movement of inventory and the funding issues that are coming up, we would remain cautious on this sector.
Harsha, my final question really, and that's got to do with not a stock really, but that stock is in the 52-week highs, and that prompts me to bring that question on par. Adani Par is the one that I was talking about. But, this Supreme Court ruling which asks the two bodies to come to a solution, amicable solution, and maybe it works to the favor of Adani Par and Tata Power, but that notwithstanding, do you reckon that the higher merchant power rates, the increasing demand at peak as well, and the fact that there could be a resolution, all of this put this pocket in a sweet spot from an investment perspective, or is it something that you're not quite convinced about?
Currently, we do not have any positions in the power generation sector. We may have players who have some merchant capacity and who will gain if demand continues to remain strong and if merchant rates continue climbing up. But other than that, we have not taken a big call on the power generation segment. As you rightly mentioned, there are still large litigations that are going on, and we really do not want to get into something where there is so much of uncertainty at this point of time. So we have been very cautious on the sector even today.